All right, let's talk investing. You know the big question, right? Which strategy is going to win this year? Is it value? Is it growth? Momentum? The thing is, the market star player is, well, it's always changing. So how do you build a portfolio that can actually perform consistently when the rules of the game keep shifting? That's exactly what we're going to unpack right now. Here's what we've got lined up. First, we'll get into something I call the winner's dilemma. Then, we'll talk about how to build an all-star team for your investments. We'll peek inside a structure called a fund of funds, cover why it's a smarter, not harder approach, run through the essential risks, and you definitely don't want to skip that part. And finally, we'll help you figure out if this is a strategy that might make sense for you. Okay, so let's dive right into the core problem every single one of us faces as an investor. We all want to back a winner. But, picking the right investment style or a factor at exactly the right time, it's way, way harder than it sounds. Let me just ask you this straight up. If you had to put your money on one single investment style to be the top performer, year in and year out, what would it be? Just think about that for a second. Is there really one that's always the champion? Well, the short answer is nope. There isn't one. And this chart just lays it all out there. Look at this chaos. In 2007, Alpha and Momentum were the absolute heroes. But then just 1 year later, during the 2008 crash, they were at the very bottom of the heap. And who was at the top? The defensive, steady, low volatility factor. And then in 2009, quality stocks just took off. It's like a game of musical chairs. The winner is constantly rotating, and trying to guess who's next is, frankly, a bit of a fool's errand. So if you can't just bet on one superstar to carry you to victory every single year, what's the alternative? Well, instead of trying to pick that one MVP, what if you built an entire all-star team? That's the idea here, to build a more robust, more consistent strategy. And here's the difference in a nutshell. On one side, you've got single-factor investing. That's like putting all your hopes on your team's star striker. Sure, the payoff could be huge, but so could the slump. On the other side, you have the multi-factor approach. This is your all-star team. You're combining different players, different skills, so you're not just relying on one of them. The goal here isn't to knock it out of the park every single year, but to aim for a smoother, more consistent journey over the long haul. So let's meet the players on this team. You've got Momentum, or Alpha. That's your high-flying scorer, chasing the stocks that are already on a hot streak. Then there's Value, who's like the savvy veteran of the team, sniffing out those solid companies that the market has overlooked. Quality is your reliable midfielder, the one with rock-solid fundamentals. And finally, you have Low Volatility. That's your star defender, protecting your portfolio when the market gets rough. Each player has a very specific job to do. Okay, this all-star team idea sounds great in theory, right? But how does it actually get put together in a real investment product? Well, that brings us to a specific structure that's designed to do exactly that. And that structure is called a fund of funds, or FOF. The easiest way to think about it is this. Instead of buying individual stocks itself, an FOF invests in a whole portfolio of other funds. It's like buying a prepackaged, diversified team in one single transaction. So the specific example we're looking at is the Kotak multi-factor passive fund of funds. Its primary objective is pretty straightforward. It aims for long-term capital growth by investing in a hand-picked basket of different factor-based ETFs. And here is the actual team roster. The fund invests in these specific ETFs. You can see all our players right here, the defender in low volatility, the veteran in value, the scorer in alpha. This transparency is one of the big perks of passive funds. You can see exactly which indices make up your team. So what does this all actually mean for you, the investor? Well, this kind of structure has some really powerful advantages. It's all about making your investing journey a bit smarter, not harder. Think about it. If you tried to build this all-star team on your own, buying all those ETFs separately every time you rebalance, sell a bit of one to buy a bit of another, you could be triggering a taxable event. Plus, you'd have to monitor it constantly. The fund-of-fund structure does all that heavy lifting for you. The rebalancing happens inside the fund, so you only have to think about taxes when you actually sell your units in the main fund. It's a much more hands-off and potentially tax-efficient way to go. And what about the cost? Well, because this strategy uses passive ETFs, which just track an index instead of paying a manager to pick stocks, the costs are usually lower. The documents for this scheme say the maximum total expense ratio, or TER, won't go over 1%, and that includes the fees of all the underlying ETFs. Here's another huge plus: accessibility. The minimum you can invest is just 100 rupees. That's it. This means a really sophisticated, diversified strategy like this is available to pretty much anyone, no matter how much you're starting with. Okay, we've talked about all the good stuff, but let's be real, no investment is risk-free. It is absolutely essential that we do a reality check before you even think about putting your money anywhere. So let's be crystal clear about this. You're looking at the fund's official riskometer, and it's right there in plain sight. This is classified as a very high-risk product. Even though it's diversified across different styles, it's still invested in stocks, and stocks are, by their very nature, volatile. So what are the specific risks you need to keep in mind? First, this fund is only as good as the ETFs it holds. Its performance is completely tied to them. Second, you're paying two layers of expenses, a fee for the main fund of funds, and then the fees for each of the ETFs inside it. Now that total cost is capped, but it's a critical detail. Third, when you look at the portfolio, you'll only see the ETFs, not every single individual stock they hold. And finally, all that rebalancing inside the fund can rack up transaction costs, which can eat into your returns. All right, so with all of that on the table, the strategy, the benefits, and the risks, we've come to the most important question of all. Who is this actually built for? Well, according to the official documents, this kind of strategy is really designed for someone who's investing for the long term, looking for that capital growth. It's for people who want that all-star team diversification, and importantly, are okay with a very high level of risk. And crucially, it's for someone who likes a passive, hands-off approach and doesn't want the headache of choosing and rebalancing their own mix of ETFs. And I want to leave you with this last point, which is a direct quote from the Scheme Zone documents. While this breakdown is here to help you understand the concept, when it comes to your own money, it's always a good idea to talk to a professional financial advisor to make sure any investment is truly a good fit for you. So we end up right back where we started. Instead of trying to guess which star player will shine brightest next year, this multi-factor approach builds a whole team of specialists. They're designed to work together through all the different market seasons. You're trading the thrill of trying to pick the yearly winner for a strategy that aims for more consistent performance over the long haul. So the final question is really for you to think about. Is an all-star team the right strategy for your portfolio's long game?